Good afternoon, everyone. I'm Stacy Scott, and I'm Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm your host for the webinar this afternoon. Thank you so much for joining us. As you know, we typically hold our monthly Lunch and Learn the last Wednesday of every month. However, with fall break falling last week, we pushed it forward to this week, and we appreciate you joining us today. Today, Graham's going to address the current economy and markets and share his thoughts on where we should go from here. Then we'll open the floor to a question and answer session, and a number of you have already emailed in a question, and so we'll definitely get to those. And if you happen to think of any additional questions for Graham, please enter it into the Q&A section of the chat box, and we'll make sure that he sees those. And just a reminder, you'll see Graham's calendar pop up periodically throughout the presentation. And if you would like to talk with Graham or anyone on our team, please enter the time and date that work best for your schedule, and we'll make sure to get that set up for you. And now, with all that covered, let's turn it over to Graham.
Hey, thank you, Stacy. Thank you all for being on the call. We certainly understand that this is stressful times. There's a lot of anxiety out in the markets with many of you on the call, and rightfully so. But what we try to do on these calls is to educate. You know, we're huge believers here in leading with education. And I'm also a huge believer. If we understand where we're at personally, we understand, kind of what's going on to cause, then we have an opportunity to have a more rational way of managing through it. Not just emotionally how we manage through it, but also how we manage portfolios for our clients. Because these times that we're going through, as uncomfortable as they are, they too will pass. And we'll be moving on to something else, because this is a part of investing, not the fun part. I agree with that 100%. This is not fun, but a part of investing. So let's go ahead and jump in. What I want to spend some time today is talking a bit about that wall of worry, right? As of Friday of last week, we saw all the indices down. The NASDAQ was down 30+%. The S&P was down, I think, 24, 26%. And the Dow was down, 20-odd% as well. Since Friday, and now we're Wednesday, the market has rallied back 5%. Think about this. The markets last week, they were down, 5.5% last week. And in 2 days, we rallied back. So some of the things that we're covering, there's some optimism that we might be seeing the light at the end of the tunnel, and I'll explain that a bit more. But let's think about the wall of worry, right? There hasn't been anything positive. And I also think when you get to an environment where in the pit of your stomach, it starts to become panic, or you can't find any positive news on TV or the magazines or talking to your friends and family, that says something. That says we might be at least in the short run, a point where the markets can move back up. Now, does it have legs and it's going to move higher? I don't know. We'll explore that today. But we're talking about the wall of worry. And it just hasn't been anything positive, right? So I used a Thomas Fuller quote, "It's always darkest before there's dawn." But I think what I get out of that quote is not just it's darkest before the dawn, but there is a dawn. And we just sometimes need to be reminded of that. So what is this wall of worry I'm talking about? And I thank Stacy for an incredible slides today. So I appreciate her for all of her hard work. But let's think about this. And I know I could probably add 10 more things on this. Certainly, maybe some things that you have personally. But let's think about it. Listen, we got a war going on. How deep, how bad is this going to get? When is it going to resolve itself? We got an inflation higher than we've seen in 40+ years. What about 8.5%? Hopefully starting to roll over. We are seeing some indications of that rolling over, and where the Fed doesn't have to be as aggressive, hawkish. You hear that term, aggressive, in terms of tightening that might push us into a recession. We have currency issues. I hear so much, oh, we got a collapsing dollar. You show me where we're seeing a collapsing dollar. There isn't a collapsing dollar. The dollar is too strong. This is important. Think about this. If a company sells a lot of goods overseas, the markets overseas or the consumer overseas is going to have to pay a lot more, right? Because our dollar is a lot stronger than that currency. So that can really hurt, one, consumers buying our goods, which is going to hurt profits and revenues of companies that sell goods overseas. Now, that's just one major part of that, and there's other issues. So we got some currency concerns. We're in a very strong dollar. We need to see that weaken a bit, but we still want strength in our own currency. We think about COVID shutdown in China, and this is big. You're talking billions of people being locked down, can't live their lives as usual. We have a real estate market issue in China. They can't produce the goods that the world wants to consume. Yeah, this affects the world because it's such a big market for consumption and production. We think about recession fears. We highlighted 3 that we think are probably front of mind for most consumers, recession fears, right? What does a recession mean? And we're going to get into that in a minute. Is it something to be feared? Well, of course, no one wants to go down in their accounts. No one wants to feel bad in terms of their monetary stance or physical stance. But listen, they're going to happen. We have to embrace it. We have to understand it so we know how to get through it, right? So I think in recession fears, inverted yield curve, you hear this all the time. Think about that. When you're buying debt, okay, bonds if you might, and let's talk about the US debt. If you're buying debt of the 2-year treasury, you wouldn't expect that to pay out more income to you than 30-year, right? Because think about this. If you're buying debt in the shorter term, they're not going to have your money as long. So you don't have that long-term risk or opportunity risk there. You should get paid less, right? But that's not happening right now. Now you're getting paid more for it short-term and not long-term. Inverted, not the other direction. That is signaled a recession basically every time we've seen an inverted curve. And you're probably thinking to yourself, well, Graham, oh my gosh, we're talking about a recession. Yeah, but we've got to mentally disconnect recessions, depressions. Different. 1929, 2008. Listen, consider those. Those were depressions. 2008 collapse of the financial market. Is that really what we're talking about now? And I know I'm really being straightforward with you, but I think we just need to embrace some things that are just getting a bit carried away. But are we really facing that? At least in our opinion, no, we're not. Is it painful? Is it uncomfortable? Are we out of the woods yet? No. I'm not going to sugarcoat that. I don't want to be flippant about it. It's not comfortable. The inverted yield curve signals a recession. Technically, we're probably in one, or it's going to be deep and pronounced. We don't think so. We'll just have to see how it unfolds. But if we talk about the things that are highlighted the most on the wall of worry, at least with the yellow markers, let's think about, we're talking about the Fed, and we're talking about inflation. And what do we think they need to see? And they basically told us they need to see things break, they want to see pain, and then they want to see basically these 4 things. They want to see wages coming down, right? They want to see food costs coming down. They want to see housing coming down, the value of the house, which is the largest asset for most of us, most consumers. They want to see that pain in the housing market. And let's talk about employment. Yeah, they want unemployment to go up. Think about that. They want pain before we can get to pleasure. That's like the opposite, right? So you got to take your mindset and kind of flip it a little bit, because what you're going to be hearing on the news and what we've been talking about is we are seeing rollover in certain areas. We're seeing a rollover in the used car market. We're seeing used car prices coming down. We may be seeing wage pressure starting to come down because intent to hire is off over 1 million. Now, that's a precursor to unemployment increasing, right? We just have to wait and see when this starts coming out. We're already seeing housing prices coming down, 14% or 14-year lows on this. I forget exactly the figure on that. So yeah, we're seeing prices come down on there. We're seeing the demand for housing coming down. Why? Think about this. If they're raising interest rates, and just 8 odd months ago on a 30-year, you could basically get it at 2.6, 2.7% on a 30-year mortgage. Listen to this. You're paying over 6%, probably close to 7%. I mean, that's a massive difference. So psychologically, financially, yeah, that's putting pressure on the housing market that's already pressured to begin with. All right. We think about employment. That's one thing they need to see. And that sounds kind of odd, right? But think about this. At 3.5, 3.7% unemployment where we're at right now, that's basically considered full employment. So the Fed's mandate is, I think, closer to 6. I could be off there a bit. But yeah, they want to see employment go up. They want to see pain. They want to see wages coming down. So if you feel less wealthy or you can't get a pay increase, most importantly, you got a real question if you're going to have a job, which hasn't been the situation. Because if you wanted a job, you had a job, you want a raise, you could probably ask for it, maybe get it. But I think that's coming to an end here. So I think if we see unemployment go up, which is going to check the box for the Fed, housing's coming down, your wages are coming down. Listen, you're going to feel less wealthy because the market's been coming down. Your home is worth less. You're probably going to spend less, maybe on foods and other services. Boom, that's coming down. So I think what we have to see, the Fed's made it very clear. They want to see these 4 things come down. They want to see some pain. So all that being said, and now I've made you feel really terrible, let's start looking at some recessions and bear markets and corrections. Because I started out this call saying, how can we make rational, non-emotional business decisions if we don't understand the facts? Now, I'm a huge believer of the past. I'm a big believer of history. I'm a student of it. If you're a client of ours, you know we are. Listen, we don't have a crystal ball. No one does. But we know that the past leaves clues. It has some rhythm to it, right? It might not always repeat itself 100%, but it does leave us some clues that we can say, okay, based on this could be a reasonable expectation. And sometimes that's all you need to make the most or the best business decision possible. So we think about recessions. Let's cover that. What's the frequency? We've had 33 recessions since 1854. This isn't the first one. We've had 10 since 1950. Nope, still not the first one, which is less than 15% of all months since 1950. Think about that. If you're in odds out of 100%, 15% is not bad. So what, the other 85% of those months were not in a recessionary period? So to absorb a little bit of pain for long-term gain is not unreasonable, right? Now, they're relatively short. We've had 11 cycles since 1950. And if we studied those, the recessions have lasted anywhere from 2 months to 18 months. 2 months to 18 months. Arguably 270 days, not quite a year into this. 18 months, there's 12 months in a year. I think you can do the math. The average is about 10 months, 270 days in it. Now, are we officially in a recession? Technically, probably. Not necessarily from the Fed standpoint. If we're not technically in a recession, could we go in a recession? Arguably, yes. Are we going to have a recession? Of course we're going to have a recession. Is it going to be this year? Is it now? Is it next year, 2 years, 5 years down the road? I don't know, but the odds are we will, because that's what happens over time, right? Recessions seem to occur every decade, right? And it's usually followed by really, really, really strong growth. Why is it followed by really strong growth? Because we have periods of dramatic outperformance. Think about this. The S&P index, which I'm going to call the market for our call today, the market's averaged 10% since 1929. The last decade, we've averaged 15%, 50% above trend. 50% above trend. Listen to what I'm saying. In the last 3 years, take out this year, we've averaged 26% return. Is it unreasonable to know that recessions happen? We're going to have it happen. You know we're going to get out. You know where history has said when we get out, even during the worst ones, 2008. Is it unreasonable and unrealistic to say, hey, listen, we could be in a recession, we're going to go into a recession, and I know we're going to get out of this. So what? I need to plan accordingly, protect myself in the short run, but know there's a long-term here, which there always is. And you know we're going to get out of it. Now, they've been less impactful compared to expansion. So think about this. From a gross domestic product standpoint, that's growth of the economy, recessions has caused about 2.5% depreciation in the gross domestic product. But during expansionary periods, that's caused roughly a 25% expansions. So if recessions are 15% of the months from 1950, the other 85% are causing massive expansions in the economy. So yeah, let's go through periods of euphoria that we just left, where money's in the bank, we can't lose our job, we can't lose our house, values have gone up on our house, we've gotten paid more in our jobs. If we want a job, we got a job. We have to expect that frothiness, right? Frothiness to come back so we can set ourselves up for another period of great markets, which is exactly what we're doing. Here I'm going to talk about bear markets and corrections. So let's think about it. We've had 26 corrections. Let me define these. A correction is 10% more, let's say, of the averages. Let's just use the S&P for kicks and giggles. But a bear market is 20% or more, right? So bear markets, corrections, 20% or more. We have those all the time. 26 market corrections since World War II, an average decline of about 13.7%. Now we're in bear market territory now. NASDAQ's down almost 30, S&P's over 22, 24%. I know we've had a rally the last couple of days, and the Dow's off, 18%. But they've been 12 bear markets, 20% or more since World War II, with an average decline of 32.5%. Now think about it. This is an average decline. Not every recession, let me flip this. Not every bear market has had a recession. Think about that. But every recession, I think, has had a bear market. All right. So let's look here. Bear markets have lasted on average about 14.5 months. How long did we go down? We started the year basically down 20%, went right down into it. Listen, we're 10 months in, 9 months in, however you want to consider it. Usually averages 14.5, so you're taking the worst and the best. We got an average. And it takes an average of about 2 years to recover. Now think about it. It's not 2 years of being down and continuing to go lower. It's maybe a period of time you went down, and then we have a period that we move sideways a little bit. And then we start that rally back, right? Returns are strong once the bear markets end. The average, think about this, the average 12-month return after the bear market is 43.4%. 43.4%. Absolutely massive, right? So that kind of gets me to the next slides. Let me just check on our time. Let's look at this. So we're talking about, on average, the stock's performance, worst 1 year before a recession. It's worse. The 2 year following a recession, prices return positive 82% of the time. Look, we have all major recessions in here. 1953, 80, 2001, 2007. Let's focus on that one, because that one's been really bad. I think that was a collapse of the financial system. Lasted 1.5 years, just over a year and a half, right? Almost 2 years. Look at this. 12 months before the market was confirmed, up 4%. 6 months after, we're up 21%. 12 months after, up 12%. 2 years after, up 44%. Look at the latter two columns. 12 months after, 2 years after, heck, 6 months after. Do you see any average negative numbers there? You don't. Now, I'm not going to say that this time is going to be different. I don't know if it's going to be different. We don't know if the market's not going to go down more compared to just going right back up. I don't think so. I don't know if it has to go down a lot more. We'll just have to see. But let's think about the longer term, 6 months, 12 months, 12 years, knowing how long this is going to last. The market's up 7, 15, and 20%. It's up 82%, 91%, and 2 years later, it's up 82%. The odds are this thing's going to bounce back. It's not the end of the world. Now let's look at past growth scares and bear markets, right? Let's look at these. You throw out any time. Black Monday, I think that was pretty bad. 87, the markets are down 33.5%. We're not down that much. But 12 months later, we were up 21. Down 19% in gold forward, we're up 29. Asian monetary crisis, financial collapse of Asian systems, we're down 19%. Next preceding year, we're up 37. COVID-19 sell-off, I mean, that's an interesting one, right? Down 33, but up 77. Trade wars, financial crisis, 2007-8, right? Down 57 rough percent. A year later, we're up 68%, right? So I guess the moral of the story you're getting it, we get through this, right? So what do? We don't panic. I know it's uncomfortable. I know you don't like it. I don't like it. I don't like it for you. No one wants to go through this. But it does give you an opportunity, as I mentioned to a client earlier today, to clean out the pipes, right? Dust them off a bit, clean them out so the water flows more purely and efficiently through it. And that sets us up for this next great bull trend that I think we're going to have. Now, I don't know when that's exactly going to happen, but don't panic. Understand your risk tolerance. Have the plan. If you have a plan in place, and I know you hear this over and over and over again, but it's important because when you go through periods of panic and stress, if you have a plan, you're more likely to implement that plan, be less stressful, and make good business decisions that are positive, period, right? Expenses, watch your expenses. If you can pull back a little bit, maybe you got a little extra discretionary funds, been spending out there because we felt a little richer maybe a year ago, 2 years ago. Maybe we ran it in a little bit. Have those emergency funds, 6 to 12 months. We're tearing our pre and post retirees. I want you to have 1 year of your fixed expenses in cash equivalents. I know some might say that's conservative. Some might say that's not enough. I think that's a great starting point. Diversify. Always focus on quality. The period where you could take a ton of risk and focus on these great products and services, no profits and revenues, I think it's behind us for a period of time. You got to focus on quality. Quality never goes out of style. It's going to work for you. Even quality goes down, but it doesn't stay down long and it doesn't go to zero. Okay. And then most importantly, and I want to stress, I wish I had a big neon sign on this. Stay invested. Of course, set some money on the sidelines, right? Have your cash reserves. Set a little money on the sidelines, a little extra, just to manage your anxiety. Get it. But don't leave the markets because there's always a market somewhere, right? There's always someone buying and selling. If it's not in stocks, it might be in the government treasuries, which are a unique environment right now. It could be insurance products right now. It could be on certain sides of the markets, right? Oil and gas have done pretty well, but I think high growth tech hasn't, right? So there's always markets. So stay invested. If you're working with someone, ask where those are. If they're not talking to you about it, you should ask why are they not talking to me about it? I know we talk to our clients about it. If you don't feel like we are, pick up the phone. We're here, right? We don't always know to pick up the phone to call you because not always do we need to make adjustments. Sometimes when you have a plan in place, the best move is no move because that in reality, that is a move, right? So sometimes not making a move because the plan is not broken, it's in place. Only thing we do is we implement, we write out through education and information because we know we're going to get through it. I think I've beaten that up pretty good, but stay the course, right? So we're here for you. I mean, long story short, I know it's completely uncomfortable. I'm not comfortable, but I understand the past. I understand we have plans. I have a great idea of what's going to happen, but not a crystal ball here. We could go lower before we go higher. We could stay in this thing a little bit longer than I think, but I do feel, as I said in previous calls, I do feel, and I'll put it back on the recording again, I do not feel we're going to be in a deep protracted recession. That could change, but right now I don't see that in the numbers. I do feel that the Fed's going to have to blink here. They're going to have to, all of a sudden say, hey, are we going to pause? Have we done enough? And I think that is what the market is trying to take some cues off of with some economic numbers that came out over the last couple of days, hence the rally of 5%. Does it go straight up? Absolutely not. So let's don't get lulled in a sense of comfort. Let's make sure we follow what I mentioned on the last slide. And you know what? You're going to do just fine, even though I know it's uncomfortable. We got a plan. If you don't have a plan, you should have one. We're here for you. All right. Every step of the way. Stacy, let's open this up to some questions and answers.
Sure. The first question I have is, how long do you think this can last?
Well, that's $1 million question, right? You don't know. But going back to some previous slides, I mean, let's flip through the side here real quick, right? So how long do recessions last on average? 10 months, 2 and 18 months. So let's say the worst is 18 months, 18 months. Let's look at 2007. How long did that last? In 2007, 8, I would say that was pretty bad. That was 1.5 years. So there you go. And I don't believe we're anywhere at a 2008 crisis. I don't care what some pundits in my industry are saying. Sometimes they're just getting paid to scare you to death, right? And that is not a proper tool for managing assets and making wise decisions. Nor do I believe that you listen to the pundits on TV and say that everything's perfect, nothing's wrong, because that's not correct anyways. I'm a big believer that somewhere in the middle, and we manage to that, right? Based on your personal goals and objectives. Go ahead, Stacey.
Okay, what are the chances that the markets could go down even further than they are now?
I mean, I mentioned earlier to a client, I can make a statement all day long why the market should go down another 20, 30%. I absolutely don't believe that's going to happen. I can't say that the markets aren't going to go lower before they go higher. But I know 6 months from now, after we get through the period of recession talk and bear market, I know 12 months, I know 2 years, I know 3, 4, 5 years, the markets, odds are they're going to be a lot higher than they are today. So if we look to the past to give us clues for the future, I don't think you can dispute that. That's at least been what's happened in the past, and I believe it does have some rhythm and rhyme.
Okay, are there any certain areas that hold up better if we go into a deep recession?
Well, I think your traditional markets, which have held up the best right now, energy because of a unique environment, supply chain issues, the war, so on and so forth, has held up reasonably well as long as demand's there, which I think it would be. Utilities, staples are always a safe haven. You certainly, in the bond market, I think you can look back at some 2-year treasuries. You can look at I-bonds. You can't buy them through institutions like ours. You got to go through the treasury, but that can be a safe haven because it's tied to inflation. And right now it's very unique. You're getting very high returns and a contractual guarantee on your money. So yeah, I think those would be kind of the traditional safe havens, but I would caution about waiting too much on one side or the other. You know, when you feel the urge to go all to one side, you got to remember that side of the ship's going to get pretty tippy, right? So you might want to leave some of your troops, some of your crew, if you might, on the other side. So hence, don't go all growth, don't go all value. You know, think about where you're at, your time horizon, your risk tolerance, you know, where the market's at, and have a good diversified portfolio between all these areas, and then you can ride it out.
Okay, well, thank you so much. And thank you for addressing a lot of these concerns that I'm sure are at the forefront of a lot of our viewers' minds. And hopefully you've managed to put some people at ease with this advice.
Sorry to interrupt you. I do think I saw one more client pop in with a question. I heard from an analyst that this crash, we're not in a crash, is going to be worse than 29. Plus, the dollar is supposed to crash. Well, I think I already addressed. The dollar is not collapsing. It's actually an extremely strong dollar. Absolutely don't see that happening. I don't know about a 29 crash. Remember, in 1929, you had a lot less money in the system, a lot less individuals who were investing. So 29 crash, nope. 2007-8, don't plan on that either. But are we in the middle of a bear market that could get worse? Sure. Do I feel that most of the damage has already happened? Yes. Do I think we're going to bounce out of this overnight? Nope. I think sometimes it's okay to just understand that things aren't great. They're going to get a little bit worse before they get better, but it doesn't mean the market's got to go tremendously down a lot worse. Doesn't mean it won't. And maybe we just move sideways for a little bit. What's wrong with that? And then we set ourselves up, right, for better times. So no, I don't think we're going to have crashes. We're not in a crash. I don't think we're going to have a collapse of the dollar, but I think that's a great question because I know that's a big concern.
All right. Well, thank you to those who sent in questions also. And thank you for joining us today. Just wanted to share a brief reminder to all of you that you don't have to wait for these monthly lunch and learns to be updated on the current market conditions. Graham also shares a lot of this timely information on our weekly wrap-ups every Monday. So please join us for those, and you can get weekly updates on what's going on in the market. And also next week, we are hosting our October Retirement Planning Today class. And it's going to be at Marietta Community School. So if you know of someone who's at or near retirement age, please put them in touch with us, either by phone or they can check out our website. We would love to see them in class. They'll learn the A to Z of the retirement planning process, and what better time than now to get started on that. So thanks again for joining us today. We hope to see you again at the end of the month for our next Lunch and Learn. Have a great day.
Take care.